Hi everybody, it's Rowan Smith with the Mortgage Center. The last couple of weeks we've seen a lot of announcements about mortgage changes, rules changes, and how people are going to be qualifying for mortgages going forward, especially the variable rate. And that's one of the biggest changes, and it's something I wanted to cover today and talk about, which was how are variable rate mortgages going to be affected, and how are people's ability to qualify going to be affected under the new rules. So the government has officially announced now that the rate they'll be using to qualify people for a variable rate mortgage is going to be the 5-year posted rate. Now presently that's 5.39%. So compare that to currently with a lot of the non-bank institutions and the non-traditional institutions, one of their biggest abilities to gain market share has been that they qualify people for the variable based on many times a 3-year discounted rate or a 5-year discounted rate. There's various policies all over the place, and it varied from lender to lender to lender. And we as brokers took advantage of that by finding the best rules that fit our clients and getting them the most amount of mortgage that we could. Now going forward, that won't be the case any longer. The government has officially leveled the playing field, so anybody offering a variable rate mortgage will have to qualify at the new 5-year posted rate. Or not the new posted rate, but the existing posted rate. So let's see what kind of a difference that'll have. If previously, under the old guidelines, if you made $60,000 a year, and just assuming that the average taxes and heat and stuff, and assuming no other debts, you were able to qualify for $460,000 of mortgage for a variable. All right. Under the new guidelines, that's reduced to $364,000 that you're able to qualify for. That's a reduction of 20%, almost 21%, that you're no longer able to afford. So if you're looking at a price that's worth a property that's worth $800,000, and in today's market, under today's rules, fast forward 6 months, and the number of people that qualify for that is going to be dramatically reduced because everybody is going to be qualifying for 20% less than they do today. Now, this may bring some long-term stability to market, but I'm going to bet that there's going to be some growing pains during the transition from the old rules to the new. Now, when's that going to take effect? Well, April 19th is the date that this is going to be the law, as it were. However, some institutions may move to this sooner. Often they do. That's the deadline when everybody has to be on board with this system. Now, a lot of institutions already use this rule. Some of the big banks, HSBC, whatnot, they already qualify you based on a posted rate. Now, they use a 3-year posted in many cases, but and there is a big difference between a 3 and a 5-year. But the whole purpose of this is to determine what can somebody afford now and what can they afford if rates should rise. And it builds in a safety net, builds in a budget, it builds into the budget that rates may increase and that payments may increase, and this will be better for all of us in the long term. In the short term though, if you're trying to stretch to get the maximum amount of mortgage that you can, perhaps because the bank doesn't accept your income, or you're on a relatively new job, or there's mat leave, or something like that coming up, you need to get on this now and you need to qualify and purchase now. For the Mortgage Center, I'm Rowan Smith.